The 16th meeting of the Group of 20, or G20, is due to take place in Rome on the 30th and 31st of October, and doubtless the two-day shindig will attract a lot of attention. The Italian presidency of the G20 is driving three key themes: people, planet and prosperity, but what the event will mean for the narrow and one could say selfish needs of financial markets is hard to divine. Those investors with harder noses may pay more heed to the trio of central bank policy announcements that are scheduled for the coming week in Canada, Japan and the European Union. The first named is due to pronounce on Wednesday the 27th of October, the latter two on Thursday the 28th. The total number of interest rate hikes from central banks this year is now 65, after increases from Poland, New Zealand and another from Iceland recently, so it's not just emerging markets who are now fretting about inflation. Moreover, the Reserve Bank in New Zealand mentioned bubbly house prices as a reason for its first rate rise in 7 years. Let's see what the Canadians, Japanese and Europeans have to say, but by way of a reminder, the Bank of Canada's headline overnight rate stands at 0.25%, and it's already tapered its quantitative easing or QE scheme down to 2 billion Canadian dollars a week from an original level of 5 billion. The Bank of Japan's held interest rates at minus 0.1% since 2016 and has been running quantitative easing at an official rate of 80 trillion yen a year for the same time. And the European Central Bank's headline refinancing rate has stood at 0 since March 2016, but at its last meeting in September, President Christine Lagarde seemed to announce a tapering of QE, even if she said it was nothing of the sort. The ECB announced it would slow the pace of its monthly Pandemic Emergency Protection Programme, or PEP, to between 60 and 70 billion euros a month, down from the prior run rate of 80. Economists and investors will therefore be looking to see if there are any changes or shifts in stance, and for the moment at least, the trend seems to be towards tighter policy, or at least policy that's less ultra-loose. On the corporate front, we have an interesting week ahead of us as the reporting season picks up pace. Names which may be worthy of further study include the following, although please do note that the dates are still potentially subject to change. HSBC on Monday the 25th of October, Bunzl, Polymetal, Whitbread, Reckitt Benckiser and Softcat on the 26th, GlaxoSmithKline, Aveva, Fresnillo, Wix and Contour Global on the 27th, Lloyds, WPP, Travis Perkins and C&C Group on the 28th, and then Glencore, NatWest and Convatec will close out the week on Friday the 29th of October. But for me, the company most capable of causing a fuss in the week ahead is Royal Dutch Shell. The oil major is due to release its third quarter results on Thursday the 28th of October. Shares in Shell are up by some 80% over the past year, fired by a rebound in oil and gas prices, and the FTSE 100 member has already provided a few details as it published an unscheduled third quarter update on the 7th of October. Then, Shell noted three things: a $400 million hit to profits from Hurricane Ida in the US Gulf of Mexico because of lower oil production, lower gas production and lower liquefied natural gas production, reflecting the impact of the hurricane, or indeed, in the case of LNG, availability of feedstock. Second, Shell flagged increased operational expenses across several of its operations, with the result that margins will be flat compared to the second quarter at marketing, petrol stations, and down at chemicals. And third, however, the oil major did see refining margins increasing as it added that higher oil and gas prices and trading profits have helped to boost cash flow. Now, on a current cost of supplies, or CCS basis, Shell reported pre-tax profit of $2.6 billion for the second quarter and $5.5 billion on an underlying basis. That's one benchmark for Q3, when a year ago Shell made just $177 million on a CCS basis and $955 million underlying. After that headline number, analysts will again look to the business mix. On a CCS basis, in the second quarter, Shell made $2.4 billion upstream, that's exploration and production, $33 million only from downstream, refining and marketing, $462 million from chemicals and $422 million from integrated gas. All of those were higher than in Q2 2020, except for downstream. Attention will then switch to cash flow. Analysts expect capital expenditure of around $19.5 billion this year, barely changed from last year and down as a percentage of sales. Now that may reflect public and political pressure not to drill and explore for more hydrocarbons, even as demand continues to recover in the wake of the pandemic, plus management's plans to reshape the business mix and drive Shell towards greener, more renewable sources of energy. But it might not help the near-term price squeeze in oil and gas if the economy stays on track and hydrocarbon demand keeps increasing. Cash flow pays dividends and funds buybacks too, and Shell is planning to distribute between 20 and 30% of cash flow from operations as dividends. As a result, it increased the payout to 24 US cents a share in the second quarter, from 17.35 US cents in the first and just 16 cents in the fourth quarter of last year, a year in which the giant cut its distribution for the first time since at least 1945. That meaty increase in Q2 means analysts now expect Shell to pay out a dividend of 84 cents a share in the whole of 2021, equivalent to around a 3.5% forward yield, and enough to make the company the third highest dividend payer in the FTSE 100 in sterling terms, behind Rio Tinto and British American Tobacco. Shell also launched a $2 billion share buyback in July, with a plan to finish that by the time of these results. It'll be interesting, therefore, to see if a fresh scheme is planned. I hope that you and your families are all in good health and good spirits. Thank you for listening, and I look forward to talking to you again next week.